This is the Business Stuff Podcast. This is where I will share the lessons I've learned from advising thousands of businesses over almost 30 years. Each episode will give you practical insight to allow you to learn from other people's mistakes. I'll be pulling in experts from our team and the world of business, and together we'll make sure your business is giving you what you want. My name is Martin, and this is the Business Stuff Podcast. Hi, it's Martin from the Accelerator team, and I'm here with Kirk Freeth from the Platinum guys. Kirk, this is version 2. People might not know this, but we recorded an episode that was meant to come out. I think it was after Truss had won, but before Quasi had stood up.
And then soon sat back down.
And a couple of days later, of course, so a couple of days after our podcast last time, we were meant to be talking about the market, and of course, we pulled that because it wasn't worth it. So we're now the other side. We've got hunting there. We've got, in theory, things have came back.
Yeah.
But hopefully we'll have a proper discussion now about what's going to happen over the next year or so, what happened, why it happened.
Yeah. Hopefully, and then hopefully this one will go out this time, eh? But
and hopefully nothing's going to happen in the next couple of days. That'll. So anyway, Kirk, tell us who you are.
So Kirk Freeth from the financial guys. I think you said Platinum guys at the start. So the financial guys, which is part of Platinum Financial, hence the double. But essentially, my role is mainly as a mortgage advisor. I look after the mortgage side of the business and also look after the equity release side as well.
Right, okay. So that's why you're here.
Yeah.
And what we're going to talk about then is what's happening with the mortgage market. Yeah. Our audience is typically business owners, but I think it's worth just talking about, home mortgages, changes and restrictions of how you can get them, the rates, you just call it the stress testing, all of those things, buy-to-lets, because everything's been affected, hasn't it? Since the last episode. Nobody saw.
I think it was when it was the news of remember the affordability tests?
Yes,
we're getting rid of those. Okay, but I remember that.
So what can you summarise then in 30 seconds without switching people off as to kind of what happened?
It's boring people to death about mortgages.
No challenge there. Summarise the last 60 days politically without...
Been mad, hasn't it? In general, in the whole financial world. But for me, I just focus on the positives really, in that there's still lenders. It's not like years ago all want to lend money. There's been no real massive restrictions in terms of lending. Whether we talked about last time with regards to being self-employed, which I'm sure we'll come on to. Yeah. There's not been any real drastic changes other than just stress testing for buy-to-lets, which we're discussing before, weren't we? And for all there was mention of getting rid of affordability tests, they're still there, aren't they? And rightly so. Because
I think this was slightly before that. There was panic in some of the mainstream media that were going back to pre-2008, 125% mortgages and all of those scary things. And it's interesting because I'll come back to that, but there is still affordability testing.
Of course there is.
It might be done in a different way, but I think one of the points I said at the time to ITV, I think it was, I was on that, I don't know why I was picked by ITV to be questioned about on the telly, but banks still only want to lend to people who are going to repay their money.
Of course they do.
There's no financial incentive, as much as people think there's some kind of weird thing we don't know about where banks want to lose money. They don't. They want to make money.
Of course they do. So they want to make money, and above all else, they've got a duty of care to you as a consumer, client, whichever word you want to use, to lend responsibly. And they have to put their systems and protocols in place to do that, and that will always be there. And naturally, with interest rates being higher, the overall amount you borrow is slightly lower, which, being realistic, is correct, because you've got less disposable income to spend on your mortgage, cost of living, things have gone up.
Because if you've got £500 a month you can spend on a mortgage, you'll now borrow less money for that £500.
Yeah, of course. We're not talking huge amounts of money, but for me, it's realistic. And if I was sat down with you as a first-time buyer, for example, you've got the first conversation is, well, what do? you've got to enjoy your life as well. You're not just going to mortgage to the hilt and sit in the house and eat beans on toast every night. Yeah. So it's just finding
it's avocado on toast.
Oh, avocado now. You've got up in the world.
That's somehow the reason people can't get a mortgage, but also all they spend their money on once they've got a mortgage.
Bit of Waitrose avocados.
So let's break these down then. So homeowners, I mean, is it just as simple as to say is people getting a mortgage now as opposed to pre-qualifying will pay more money? Is there anything that's less?
In a nutshell, I mean, it just went, in the markets in general went crazy, and now what we're seeing is the slow sort of slide back down towards, nowhere near where we were, but slowly sliding down. But that initial jump up, you just scared the life out of the world, in all fairness, didn't he? And that's why we suddenly went 6, 7. I think at one point, I think the average interest rate on a fixed rate over 5 years was 7.2 or something like that. And when you're thinking, what's going on? So thankfully, we're coming away from that. But going back to, when we're saying focus on the positive, remember like pre-2008 at the time, lenders just didn't really want to lend money. The top motivator was, yes, we are here, we've got these mortgage deals, but realistically, we're going to make it as hard as possible for you to give you the money. Now, they still want to give you the money. They're still there. There's
still the desire to get the money out there.
There's absolutely an appetite for the banks to lend you the money and make money themselves.
So that's not to say, though, that there aren't people who are getting hurt, because a simple example, someone who took a mortgage out a year ago on a year fixed is coming out now, and they're kind of hit with a couple of different things, aren't they? In all likeliness, they're going to pay more now because they won't be able to get the same deal. Is it? Not always, but probably if they were relatively highly geared, they were borrowing as much as they could. Yeah. And of course, the interest rates generally have all worked against them, haven't they? So, what? I mean, is there anyone who's coming out who is not getting a mortgage, or is everyone? I suppose you can always stay on their variable, but it might now be much higher. Is it?
Yeah, I think everyone's circumstance will be different, but in reality, you could roll off whatever. I mean, I can't remember what the percentages are. Probably 90% of the country are on a fixed rate, and the majority of those are on a 2-year fixed rate because that was the right advice at the time. And then they'll roll off, and then it'll be: do I stay on the standard variable, which could be 6-7%? Do I then choose a new fixed rate? Do I look at a tracker? And that's really where the value of advice comes in. But whichever way you look at it, your monthly payment's going to go up, because the majority of people in that last 2 years have been on 1, 2, you know what I mean? A really low rate as to what it was at the time, unless you were rolling off a 10-year fixed at whatever at the time, ages ago. But it's...
Because it's interesting as well, as this is the weird thing, the papers have gone, I think you've said the word nuts a couple, but the papers went absolutely nuts about, everyone's pulled all of their deals, and everyone's going to lose money. All the deals didn't go, did they?
Yeah.
Quite a few went, but came straight, like a lot of them came pretty much straight back a couple of days later.
Well, people don't realise, it's totally normal. Lenders change the products all the time. Some might do it once a month, some
it just so happens
so quickly. Yeah. But then because of the changes were happening at such a rapid pace, they go, right, we're going to take this product away, and we're just going to have to take a couple of days to look at it and go, what is going on, before we decide what we're going to bring back to you as the consumer. And that's all. Whereas now it's just a seamless product moves, new product starts. But then
because there's no emergency, whereas there was that perceived emergency for a couple of days.
Yeah, there was, because then they needed to, I had meetings with the government and all sorts of things. What is going on? Like, what are you doing to the economy? Because we now don't know what to do. And that was why that gap was there. And then the media jumped on it. Oh, there's no mortgages. Well, there was. But
also the other thing was, you've alluded to, whether it's 90% or not, I'm sure someone will
fact check that. I'm sure
someone will full fact us in the comments. But a high proportion of people are on fixed, aren't they?
Yeah, of course.
So they're totally unaffected.
Yeah.
It just
until
they won't even know it happened, and possibly by the time they come out the other end of that fix, depending on when they got it and how long it's for, might not even spot that much difference, might they?
No, it might be. I mean, for those that took a 5-year fixed rate, for example, you never know. It might work really well for them. It might not. Yeah. Might, someone that done a 2-year fixed rate 6 months ago, it might just be a slight increase. It might be the same. It's all about being in the right place at the right time.
There's also factors, isn't there? You know, back in the day when I was approaching banks, and that, they had almost like drop-offs where if you were under 80%, you got access to slightly better rates. If you're under 60, that was like the sweet spot. You get the best rate. Is that still a thing?
Still the same. There's just not as much of a sort of margin between the brackets. So, you know,
because it used to be quite.
There was.
I mean, you used to deliberate whether you were going to pay another couple of grand down to bring it under.
Yeah,
it made a big difference.
To be fair, that was me a couple of years ago. You know, mine pay a few grand, I'd get like 0.5% less or something. Like it was like no-brainer that if you've got the money to do it. But now there really isn't a huge difference between the 85, 80, 70 to 60. There's still a gap, which is not as big as what it was.
Right. Is that something people need to be maybe thinking about? Then possibly not, if it's not the end of the world. But if they have got the money now, because one of the old sayings was, you know, when 2008 came and rates plummeted, don't just blast that money. Keep the money in our saving and do something with it. Of course, nobody did. We all just spent the money and all regret not having to pay the mortgages off and that. But you know, should people now be thinking, well, hold on, I was on a 5-year, I'm 2 years in. Maybe I should start saving up a bit in case I need to pay down the value a bit. Is that?
It's certainly something to consider, but it's really hard, isn't it? Because everyone's different. People, you might not have that, and then you think, and other factors like you know, people's gas and electric going up a couple of £100 a month, and
of course your affordability is driven by
you know
what you spend any money on. Isn't it?
And you know, it's and suddenly you might think, well, you know, you might be lucky in being a sort of fixed thing on your gas and energy tariff, and you may be thinking, oh, well, actually, I'm saving a couple of £100 a month here from what's going to be. I could just preempt that and pay it off the mortgage a little bit. Yeah. Everyone's slightly different on that.
Hence the reason for good advice.
And the importance that we all come back to is just seek advice. Yeah.
We'll not send anyone off with any sweeping statements today.
No.
Yeah. Yes, absolutely. Pay some money off your mortgage.
Overpay this amount every month and you'll have this left. No, it's everyone's.
So on the affordability then, and we'll come on to the landlords in a minute, but just for homeowners at the minute, Kirk, you mentioned stress testing and affordability. You've mentioned a lot of terms. It has much changed for homeowners with regards to just what they will allow you to build into your budget and for payment for mortgages, or is it just that the figure's gone up, so that changes what you can borrow?
Not massively, in all honesty. So the lenders will still use very similar calculations. It had initially for like what you say, you know, remember the old school, it was like 4.5 times your salary. So everyone will have that in their head. And it is very similar to that. But it's all driven on, are you self-employed, are you employed? What is your overall income? Is it over 75 grand? Is it over 100 grand? Is it under 40? Every lender's got slight little quirks to their calculations. And then obviously how much debt you've got, what are your credit commitments, which all gets taken into account. And they're all slightly different. Yes, overall you probably lend a little bit less than what you could, but it's still very similar.
I suppose you've touched on something else then. If you're looking at what you're paying out and the amount of money you can borrow on your mortgage is going to be affected by what goes out. Yeah. One of the things you might be able to control is things like your credit card debt. And so I suppose one of the considerations might be, well, actually, I'll try and pay down that credit card.
Yeah.
Or in a more general note, I will try and improve my credit score, for instance. So when you do come to this point, you've put some homework in to make it improve your chances as much as possible.
Yeah, and
is there still some argument?
And that's a really good point. You know, you could be. I think that's just that forward planning, isn't it? And knowing, right, actually in a couple of years' time, I'm going to have to remortgage. I'm going to buy somewhere. Right, what credit commitments have I got? I've got this on a credit card. Actually, you just focus on. You know, it's another conversation for another day. Balance transfers and all the rest of it. We've been talking about interest, but focus on getting that down because. Might just be a conversation with an advisor, you know, you and me, right, Kirk, this will be circumstances at the minute, got 10 grand on a credit card, 5 grand, whatever it is, right, well actually, if you pay that off, this is how much you can borrow, and you can kind of see the difference. And that might change, of course, over a couple of years, but it's roughly about the same. But the general principle is always going to be there, isn't it? If you've got a commitment to go out of 200 quid a month to, you know, Virgin Money for a credit card or anybody else, then that 200 quid's got to be weighed up somewhere, hasn't it? Of course it does, yeah.
So if you can
if you could plan for that to not be there,
then
then, you know, and you're talking about buying a house, and that could be the difference between getting it and not getting it, with a bit of forward planning, rather than looking back at it with hindsight and going, oh, I wish I paid that off. I could have paid that off.
I could have paid it off.
I could have just had that phone call, and I took 5 minutes to find out what I needed to do. So,
just before we move on to landlords, then.
Yeah.
The media would have us believe that, you know, I'm saying this as if the media is just like some evil tyrant cackling as they mess with our lives. I don't mean it like that, but of course everyone, you know, bad news sells, doesn't it? They've got to put something on the paper to scare you, otherwise you won't buy it.
Yeah.
Did it ever get, or was it ever likely to get as bad as it was in, you know, kind of the credit crunch 2008 era, or were we nowhere near that really?
What, right now?
Over
the last few months? I don't think so, personally, because
there was genuinely a lot of people who couldn't borrow money. I mean, did we ever get anywhere near the mortgage product levels as we did back then, or was?
I think the main difference is the fact that the lenders want to still lend money, whereas I think back then it was, we're kind of going to shut up shop, but pretend we're not shutting up shop.
We're open for business, but there was like cling film over the door.
Yeah, but we're not. Well, that's a really good analogy, to be fair. But yeah, I think now, honest, genuinely, it just doesn't have the same feel to it. I don't know what, I mean, you stick in the comments below if you think there's a different feel to it, but you know, when you...
But if you're speaking to, you know, your regional rep for NatWest, the Nationwide, whoever, Halifax, so they kind of go, yeah, Kirk, when are you going to send us some stuff? They want it.
Yeah, they absolutely want your business in that, you know. The housing market just in general has, you know, sales have dipped a little bit. It was only natural, it was going to happen.
Well, it was red hot, wasn't it?
Yeah, but it went from ridiculous levels to like, oh, well, kind of back to where we were. So there's always going to be that element of adjusting, and you know, but it's a positive. You know, you look at, they still want your business, and they'll hopefully drive rates down to be more competitive, and great.
Right. Well, let's move on to buy-to-lets.
Buy-to-lets, yeah.
What's happened for landlords then? Obviously, most of the things we've just talked about in some way will have an impact, because it's generally the same people lending money.
Yeah.
And they've still got to make sure it works for them.
Yeah.
Are there any quirks or anything, any changes? Has anything happened that particularly affects landlords at the minute?
So, in simple terms, the rental income...
Oh, it would be cool if you just went, yes.
Boom, just yes, and left it. Might drop and walk out. In simple terms, your rental income needs to be a bit more to get the loan amount that you probably need. So, for example, you know, this time last year, you wanted a loan of 100 grand, £500 a month rental income might have done it. Now, you're talking £700 a month. £750 is what you'd need to get that loan. And as probably most people watching this will know, buy-to-let sort of... The borrowing and buy-to-let isn't necessarily just based on what you earn, it's about what the property that you're renting achieves.
It's much more of a...
or potentially achieves in rental income.
Much more of a return on investment.
Yeah, absolutely. It's with stress test built in with regards to management charges, you know, potential not having a tenant for a couple of months, and that's kind of all factored in, but yeah.
So, you know, we talked on our weekly catch-up, week 2 weekly catch-up. I don't know how this will work. It's a couple of weeks ago, probably by the time this goes out.
Yeah.
But there were, you know, in the news there was, you know, rents have risen at the fastest rate they have in, I think it said 7 years. You know, 10-11% average increase in rental. I mean, it's always fair to say that doesn't apply to the whole country.
Yeah.
But we are probably still seeing rent increases. But they haven't gone up by those kind of rates. You know, 500 to 700 is 40%. Most people aren't seeing anywhere near that.
Yeah.
Does that mean we're going to have people coming out of fixed or as landlords then who might not be able to get, you know, again, anything like what they had? And if so, what happens to them? Do they then just fall on the variable and hope they can pay it?
Yeah, I mean, a couple of options really. You know, one, you're looking at what's the overall value of the property, what rental income are they achieving right now, and then looking at what's there. And sometimes you might have that situation where people pull out as much equity as they physically could to go and buy another property, and maybe the property price has slipped a bit in the meantime, and suddenly you're in that position where you don't have enough equity to really pick a new mortgage product. the problem that you've got there is you're kind of stuck with on the standard variable rate. Or do you take a risk trying to go with another lender and trying to get a different valuation, and it becomes a bit more difficult?
Because you could have bought a property for at 140 with a mortgage of 100.
Yeah.
You needed 500 rent, it's now 700. The figures won't work, but just to illustrate the point. So someone comes out now, the property's dropped to 120, who knows? So there isn't the loan to value that there was.
Yeah.
And now you need more rent. In a market where rents are going up but properties might be dipping in that, there will be some who just are the unlucky one that gets bit there, won't there?
Yeah, definitely. I mean, I hope it's not many, but there will just be the odd couple of unlucky people, I think. And you'd like to think as things settle down, the buy-to-let rates start coming down, then that'll start levelling off the rental. And hopefully it'll just kind of take care of itself. But there's always going to be someone there always is, isn't there? Someone that kind of hits it.
But again,
a bit of bad luck.
As long as they took good advice on the way in, then in theory, there shouldn't be too much hurt if they just drop onto the variable. I know the rate will change quite a bit, possibly, but they should still be all right.
Yeah,
because that was looked at when they went in, wasn't it?
Exactly.
It was built into the stress testing on the way in.
Exactly, and
if they were used to spending the profit, they might not have given that up.
They might not like it, but is it still affordable? Yes. Is it, it's one of those where the risks and you go through the pros and cons, and sometimes, yes, you kind of see the light bulb above the return on investment, the yields, this is great, but then you've got to see the risk side as well. Yeah. What if this happens, that happens? And then, you know what, if you were aware of all of that, you just go, that's it. It is what it is. It
stings, but it doesn't kill you.
Exactly.
Yeah. So I'm a great believer in the market fixing itself anyway.
Yeah.
Because there is a point where if lending just gets too expensive, more landlords will inevitably have to increase rent.
Yeah.
Which will then increase rent. And even if you were the one who wasn't hurting, well, you'll benefit from a general trend to try and pull rents up.
Yeah.
And I get that sounds harsh. I'm just saying, well, people who rent will just have to pay it, but that is just what happens, isn't it?
It is, yeah.
The market will correct and rents will have to go up because they'll have to.
Yeah.
There's no way around it. Someone might go up, well, I have to put mine up more than my mate next door who owns the property next door, but it'll average out somewhere, won't it?
It will. Yeah.
And in theory, there shouldn't be anyone who's borrowed more money than they can afford to pay with the rent they've got.
Yeah.
It's kind of like built into the system, isn't it?
So, like you say, that's probably a really good way of putting it. It probably will overall just correct itself, look after itself, or level off, or whatever sort of term you want to use. Yeah. But I think is a really good point. I think as long as you had that right advice initially, you'd be all right. Yeah, you know what, it might be a bit rubbish.
You'd be all right, sounds a bit casual, but
you're
not going to lose anything.
No, you're not going to lose anything. That's important.
Well, unless you are relying on that as your sole income, which...
I'd be a bit worried if you were.
Which, you shouldn't really speculate on investments as your sole source of income, and not within those tolerances, I suppose, should you?
Probably for a different podcast as well. I'm sure you've got someone into that as well, Martin, haven't you?
About sound
investment and forecasting.
So, what's happening then just on landlords and commercial or company loans? Is that just, it always seems to just be not a million miles off the individual loans?
Yeah, it's very similar, just a little bit more normally, just a little bit more of an edge in terms of the interest rate. But
is that mainly then because companies, you can't just take the landlord's own personal stuff? It's just because there's a bit of limited liability in there, so they want a little bit more skin in the game. Is that just all it is?
And plus, they're not daft. They know you're making efficiencies elsewhere, and they can take their little bit of it.
I always think this with mobile phone contracts. I don't know if you've ever done this, but if you get a phone contract in your own name, let's say it's 50 quid, the same deal through a company is 60 quid.
Yeah,
it's just because they know that the company gets the relief. It's just.
It's
just built in. They know the system, don't they?
Of course they do.
But just on the wider point then, because you mentioned before that we're on the slope.
That's what I think. It's just
explain what you mean by we're on the slope.
It's just a trend, a bit like you skiing downhill. It might not be a sort of, you know, a red stroke black run where it's like that, and you're thinking,
listen, I'm from a council estate.
Your hair on fire.
I have no idea what you're talking about.
Is that a
steep hill? Is it?
Yeah, it might be a little steep hill, but you might just be on see the light ski runs. So with green and the blue, it's just a nice slide. Yeah, so nice slowly.
Because if you look at the rates, they kind of went,
yeah.
And they're doing a bit of that, aren't they?
So we go using the ski analogy, you were up in a gondola, and you were at the top, and then now you're on that slow blue run, whereas really you want to be on the black run heading straight down.
We're not quite plummeting yet.
Yeah. Sorry if anyone's not a fan of skiing, by the way.
Or who's never been skiing in there. Yeah. But I suppose the point to bear in mind there is that doesn't mean that there won't still be increases, because if base rate goes up, we'll be back on the gondola again.
Yeah.
Even if the general trend is down, we might still have the odd up, mightn't we?
Yeah, and this is it. I think the next meeting is early Feb. You know, I think we're having a chat earlier when the last meeting they were kind of all in. You know,
next meeting of the monetary
policy committee meeting. Sorry, yeah. So we'll just have to wait and see. You know, normally
because the vote wasn't unanimous by any measure last time around, was it?
No, it was a nice split decision, wasn't it, between doing nothing, putting it up 0.75 and going up a half. So, you know, even there, still split on. And I think that's really driven primarily by where's inflation, what's the forecast on inflation, and economic growth overall, isn't it? Because that's their job.
Because I still think there's more of a gut feeling, but like, you know, after weighing up a few different sources, then taking a view, I still feel like inflation's not going to be as high as people think for as long as they thought. And if you look, you know, I mean, there was ironically, before doing the weekly catch-up last week, there was two articles. One was because commercial and residential utility rates, they work differently, one's regulated, one's not. But, you know, it's like gas prices have now hit pre-Ukraine, you know, on the wholesale market. Hasn't quite landed. It's like the old petrol pumps, hasn't quite landed on the utility bills yet. But, you know, in theory, the energy crisis, the suggestion was it's over. Well, that will wash out at some point, won't it?
You'd like to
might take a while to come through the food prices and everything else.
Time.
But that's going to have to wash out again, isn't it?
Well, Rishi's promised to halve inflation, you know.
Well, I could have promised that.
I know.
I mean, I like Rishi.
I had a little chuckle on that.
I could have promised that.
But when the forecast says half by the end of this year, I'm going to take credit for that one. But I think you're right, and I think
the sun's going to go around the world about another 360 times by the end of the year as well. I'll take credit for that one. But
wasn't it? I think the forecast on economic, like the recession as such, the thought was going to be more as well. And I don't think that's anywhere near what the thought was going to be, like 0.1.
We should get used to this. The statistics we see all over predict far worse than it ended up.
And you know, I think all that taken into consideration, in an ideal world, you just like to see things just come back to where they were. But I think there's just going to be an element over the next couple of years of just slowly adjusting rather than up and down.
If there's no more major shocks, nothing else big happens. How long will it be before we kind of know where we are then in all landlords and all homeowners, anyone with a mortgage knows? I mean, because most people don't fix for any more than 5 years, do they? So there might be people who fix just before, well, they're probably going to come out in 5 years and they might not even know any of this happened. What's the numbers? How many people take like a year, 2 year, 3 year fixed? I presume that's the majority, is it?
Yeah, it's only really been, I mean, for me, this year, when things started with the upward trend, people thinking, these are too good not to take 5 years. Like, you had loads of people just doing 5 year things. But before that, pretty much 2 year, 2 year, 2 year. It was always, you know, the way most people go. Look, all you can really do is look at the forecast. But probably what, like, you'll do in your profession. And it's hard, isn't it? Because those forecasts change all the time and you're constantly reviewing. But when you're looking at, well, inflation's going to halve by the end of 2023, 2 to 3% by towards the end of 2024. So really, everything's probably going to fall in line and adjust itself around it. You know, you probably look at the end of 2024. So
sometime next year.
Yeah, so that's probably...
Most people will come off and have to remortgage and their hurt will be over or not, whatever it is.
Yeah, so you're thinking about 2 years. Over the next 2 years, it should be kind of the new, I want to say the new normal, but
don't ever say that again, because we don't want to jinx this, Kirk.
No, because this will go out and it'll be totally different again.
It'd be interesting to go back and see if there was any predictions made actually in the last one. And
I got it right last time and you never put it out. Never mind.
I'm pretty sure you didn't say it's all going to go absolutely mental for a couple of weeks.
I didn't. I think we said 0.5%, which it did, and then it went crazy. But yeah.
Well, so Kirk, one of the things we always say to people at the end of these chats then is, what's the one thing that people just keep getting wrong? The one thing people need to do different that would make you happy as a mortgage broker, mortgage advisor?
I think we've kind of covered it already, isn't it? I think it's just plan ahead as to what you want to do. There's absolutely no harm in just having a conversation to say, look, whether your mortgage is a year away, 2 years away, 6 months away. I think that is key, and just getting advice on what you want to do, what your future plans are, not just considering I'm just doing this now, just thinking a bit more long term.
Yeah.
And I think sometimes if you just be a bit short-sighted and don't consider those, you might just, you might be something where you regret it and go, oh, I wish I'd done that.
Yeah.
Isn't that worse than hindsight looking back? Damn it.
So I mean, it seems like almost everyone who gives us any feedback on the end of these chats could almost just kind of go, just think about it.
And the generic, just
think about it a bit earlier than you might have otherwise. But it does feel like for the mortgages that's particularly relevant at the moment, isn't it?
Think about it more, I guess. But think about it more in advance.
Constructively though, not just lie awake and panic about it all night.
No, not panicking. That.
Think about it
constructively. That's why I do what I do, and it's all about the people, isn't it? And I don't know, I hope other advisors are the same and get those phone calls, you can have those chats, and it's not one of those where you're sitting there doing a 500 grand mortgage thinking, I'm earning this from it. It's not about that. It's about just looking after your client base, and if that 5-minute chat ultimately puts someone in a better position a year down the line, 6 months down the line, then they're really going to appreciate that. And as you know, our business is just based on referrals, and that's how they come.
People,
and you look after people, people look after you, and that's life, isn't it? And I'm not going to pinch a Richard Branson quote, otherwise I
don't know which one you were going to pinch. Which one were you going to?
The one where in business you look after it's a slightly different. You look after your employees. Your employees will look after your business, and you. It's very similar with Robson Laidler.
Look after people.
And it's exactly the same. You look after your clients, they look after you.
Yeah, great. Thank you very much, Kirk.
You're welcome.
I hope you enjoyed that. Any conversation that involves banks, any kind of political influence that normally gets people going, we'd love to see you get going in the comments. Let us know what you think. As always, we appreciate your feedback. Give us a like, give us a tick, give us a subscribe, whatever it is, whichever platform you're on, and you'll be kept up to date when we release our next one. For now though, thanks very much, Kirk.
Cheers, mate.
From the financial guys.
Hey.